The stock market is made up of a great many intricate, immensely complicated indicators. Some using algorithmic patterns, some using historic trends, some using live data. But some are so next level that it makes those other ones look like elementary school math. Screw the relative strength index, shut up about your exponential moving average, enough about your Shiller PE ratio. Today, we're taking a look at the Super Bowl indicator. Market indicators are a valuable tool used by many wise folks. Defined by Investopedia, market indicators are quantitative in nature and seek to interpret stock or financial index data in an attempt to forecast market moves. A lot of incredibly smart individuals and organizations have used these indicators in the past to foresee some of the most surreal market moments in history, and thus have made the right moves in order to profit substantially as a result of these. The Super Bowl indicator is, well, not as popular by folks like Ray Dalio, Warren Buffett, and Bill Ackman, but screw those guys, what do they know? The Super Bowl indicator is actually, as a matter of fact, a tool that dates back about 45 years. This is the gist on how this indicator works. The theory is that based on speculating who will win a given year's Super Bowl, you can foresee the positive or negative market impact that follows. Specifically, the indicator states that a Super Bowl win for an NFL team from the AFC, American Football Conference, foresees a drop in the stock market, a bear market, that is, for the following year. Then on the flip side of that, a win for the NFC team, National Football Conference, means the stock market will rise up for the coming year. That's a bull market, baby. So your first assumption is probably, and logically, that this is a wives' tale at best. How can this be anything but random? It can't possibly work. Well, take a pill of chill, my friend, and listen up. You ready for this ridiculous stat? This indicator has been accurate 77% of the time, looking historically at every single Super Bowl. At the time of the indicator's creation, it was right a remarkable 100% of the time. Then, in the 30 years making up 1967 to 1997, the indicator held strong with a 90% forecast success rate. It was really the 2000s turbulent, volatile markets that started to throw the Super Bowl indicator a bit askew. Let's take a look at the origin story. The year was 1978. Jimmy Carter was president. We were at the start of what became a 12-year bull market run. Fun fact for you. That run ended the infamous 1977 bear market, which followed the long run of economic and stock market downturn as a result of good old President Nixon.
We must protect the position of the American dollar.
But none of that matters right now. In 1978, there was a columnist named Leonard Kopet, a pretty popular feller in the sports writing world. He worked to create a correlation between the performance of the Dow Jones Industrial Average and the winner of the Super Bowl. Eventually, he found that at this time, this newfound theory of his had a 100% success rate. 12 out of 12 Super Bowls that came before him held true. If the NFC team won the game, a good market year followed. And if the AFC team won the game, a crap market year followed. It's just how it was. He published his findings in the New York Times, labeling it the Super Bowl indicator. And there it was. So let's talk reality. Now here we are, in 2021. What a world it is that this indicator has proven actually rather successful over the years. But let's be clear. This is a non-scientific market barometer. In reality, there really is no logical way this can actually dictate the performance of the market. Rationally, in our thinking skulls, we know that football and markets don't have anything in common. All the impressive numbers aside, all facts of this indicator's success should be taken with a fat stack of salt, especially if you're thinking of entering the market because of a Super Bowl indicated result. Or, as New York Times columnist Floyd Norris stated, anyone foolish enough to bet on a game based on the stock market or credulous enough to believe a football game can forecast the stock market probably should hire a money manager. Or a psychiatrist, or both. I would say Floyd Norris is bearish on this indicator. Sorry. Unfortunately, there's really no rational reason or model to back up that the outcome of the Super Bowl could possibly influence the market in any way. It's sad to say. As stated beautifully by Professor Manfred Fruworth, the Super Bowl indicator relies on a correlation that is purely binary in nature. If a correlation truly existed, it would make perfect sense to think that other aspects, such as the difference in score, also have an effect on how well the stock market will fare in the coming year. However, this is not the case. What is more, the Super Bowl indicator includes data collected more than 50 years ago, but the stock market environment has undergone fundamental change in recent decades. All of this is problematic. The high success rate is the result of retrospective interpretation. Since the indicator is selected on an ex post basis, it can be tweaked until it correlates with at least your sample. Well said, Doc. Couldn't have said it better myself. Clearly. I think the gist is, this is a pretty hot case of superstition meets indication. Though, what about this? This isn't the most popular indicator in the world, obviously, but it does have many people that are familiar with it. So what if, maybe inherently, the correlation between the game and the market aren't there, but in context, the world does have this superstition in their heads, this idea that the market, it will go down if the AFC team wins. So thus, when they win, the people sell out of fear by default, and vice versa. What if when the NFC team wins, the people buy out of confidence by default? There's a word for that, when that exact thing happens, and if I were smarter, I would remember it and say it right now. But here we are. I don't necessarily believe this indicator theory is popular enough to actually move markets like that, but it's worth noting. That is why news, popular publication stock picks, and social media can move markets after all. Belief and hype can be more powerful than fundamentals, oftentimes, at least in the short term. Jason Zweig of the Wall Street Journal had the honor of interviewing the founder of the Super Bowl indicator, Mr. Leonard Kopet himself. Let's immerse ourselves. The year is 2001. Bush is the president. The market is in hell, as we're fresh out of the dot-com's bubble pop. Kopet, in his olden years, is being interviewed 2 years before his eventual passing. The sports writer was flabbergasted by Zweig bringing the Super Bowl indicator up, that here he was, a quarter century after he invented the SBI, and people were still taking it seriously. Kopet stated this: his original articles were Swiftian satires on the dangers of confusing correlation with causation. Eventually, Kopet noticed a spurious correlation. How could the winner of a single overhyped football game possibly predict the performance of thousands of stocks? He tossed both of his idiotic ideas into his column, and the rest was history. It's a joke, Kopet said. I meant the whole thing as a satire on the fallibility of human statistical reasoning. Too stupid to believe. End quote. Well, that was it, folks. From the creator himself. He created a satirical indicator based on random stupidity, not science, and certainly not math. So, what now? Well, I think it's pretty obvious what we do from here. We put our sell orders in immediately. We prepare for this game like our life depends on it, 'cause it does. If the Chiefs win, we liquidate our accounts immediately. And if the Bucks win, it's all in on Tesla calls, baby. No, don't do that. That was satire alert. So if the SEC is watching, we're just joking around here. So anyway, I love weird and/or interesting stock market lore, stories, history, strategies, moves, drops, whatever, all that stuff, and this is certainly one of them. I had a blast researching all about it, and hopefully you enjoyed hearing about it. This is a pretty wild one, but there's always something to learn from even the weirdest plays on the market. I have such an intense list growing for more videos like this and like my last one, but if you have any suggestions you want to see as far as cool, wild, interesting stock market and/or business stories go, leave them in the comments. If you missed my last video on the Volkswagen short squeeze of 2008, aka the biggest short squeeze in history, go check that out now. You can pop a subscribe and maybe even a like my way if you're feeling generous, but no pressure. Well, I'll see you next time. Thank you so much for watching. Be safe out there.